Good afternoon, everyone. Uh, First and foremost, I want to thank our institute, Rama Institute of Management, to doing this webinar series and giving me a chance to be part of it. Today, we've seen some unprecedented stock market movement and fall in economic activity following the COVID event that happened in Jan-Feb. And as a result, you had a very sizable collapse in the stock market. We've had a sizable rally since then. So what next is the question that we are kind of asking them. Now, what we'll do in this session is we'll discuss the macroeconomic backdrop briefly. We'll look at the fundamentals of the stock market. We'll also look at the technicals and the underlying sentiment and see if we can make sense of all of this. Okay, so global economies have weakened quite a bit of late, but please note they were weakening even before COVID happened. So now we have weaker unemployment, we have weaker GDP, we are basically in a depressionary phase. The question begs, what is the difference between a depression and a recession? In a recession, companies disappear, but in a depression, industries disappear. So I believe we are entering in a very, very depressionary phase. So likely, we've seen the first stage of commodity market crashes, currency market crashes, and stock market crashes. And we've seen a subsequent bounce back. So most likely the next stage is going to be the critical stage, and that's what we'll look at. So if you look, economic cycles long before COVID happened were pointing down to a major down swing. So every 40 years, you can see there, that's the contractive economic cycle, which I've displayed for you. Every 40 years or so, we have in fact, a 50-year cycle, we have a major down move. So basically, there was a period from 2000 to 2020, culminating very close to where we are, where a lot of down economic activity and other down moves in asset classes was going to happen. So the economic cycles were indicating this long time before COVID. So in 2000, this all started with the dot-com bust, right? 2010 again, in between 2008, we had the Great Recession of 2008, and then now we are having COVID, but this shouldn't surprise anybody if you're a cycle watcher. Right? Okay. Now we'll take a look at the fundamentals of the stock market as we see it as of now. So recently, very weak GDP figures came. It was surprisingly high though. Came at 3% recently, the GDP numbers. Moody's immediately prompted downgrade from Moody's. If you look at where the Nifty is, one of the key indicators to look at is something called the PE ratio, the price to earnings ratio. Many great investors in the world follow this. For example, Benjamin Graham says the PE ratio of any security purchased, if is going to offer any value, should be less than 15. So, but if you look, even after this big move down in Nifty, the recent rebound, which typically is 30% or 35% of the lows, has taken the index back to a very high PE ratio. So if the PE ratio goes above 20, 22 in a downtrending market, that implies there's not much value in the market. So I've done a small calculation there. The PE ratio, if you invert and express it as a percentage, you'll get something called the earnings yield. So the earnings yield is 4.4%. This is all from the NSE website. The dividend yield is 1.55%. So if you add these two things, you get a total yield of about 6%. So if you look at the change in inflation year over year, so I've taken April end last year to April end this year, you get an inflation rate of about 5.5% change in inflation. So you subtract that from the total yield and you get just 0.5%. But if you take the 1-year return on bank deposits, you get 4%. So it means you're better off keeping your money in the bank than investing in stocks at this level, because the bank deposits are fetching you more. So stocks are very, very risky at this point of time on a fundamental basis. Now, if you use the forward PE numbers, nobody knows what the E is. That's the problem. The E can come down to very, very low levels. Many people think that Nifty companies may not earn as high as 300 rupees this year. So if you look at that level, the PE ratio forward basis is 35. So I don't even have to tell you what that is. That is in way overvalued territory. If you look at where everything bottomed, in 2008 recession, the PE bottom was about 10. So if you use a 10 PE multiplier on the trailing number, you get about 5,000 on the Nifty. A scary number to look at, but wouldn't be surprised if the market goes there in the next 2 to 3 months. Maybe most likely probably 3 to 4 months time frame. Okay, so if you look at technicals, there has been a pretty bizarre and a complete breakdown in the market. The market moved from something like 12,400 to 7,500. The 10,000 level was very key. It broke that, and that has become resistant. The last few days, it has been hanging around that. But the recent rally which we are seeing is merely a bear market rally, I feel, because typically in a depression or in the 2008 recession or any one of those cases, the market first fell, then it retraced about 50% of the move and then fell again. So we are right there sitting at that level. If you look at this graph, which shows the Nifty technicals there, this is the weekly chart. And you see the weekly moving averages of 20, 50, and 200 days. And you can see that the 20-day moving average is not only crossed below the 50-day, but it is 50 weekly, but it's also crossed below the 200 weekly. When this happens, usually major crashes that happen typically continue. So the market today has gone slightly above that 20 weekly moving average, but in the short run, that is likely to act as resistance. So I wouldn't be buying stuff here. I would rather be looking to sell, because the market technicals have been pretty badly damaged. Okay, so what do we do then? So increasingly, we are seeing some stocks doing better than the others. So if you look at which stocks have done well of late in the rally, you look at stocks like Bharti Airtel, you look at the pharma sector, selective FMCG stocks at ITC have done very good. Banks are a lot weaker. So increasingly, the market is becoming a market of stocks and not a stock market. So you have to be very stock specific. So in case at this point of time, we are at resistance, so you basically want to sell stocks with very poor technicals. And probably you want to, when the market makes a big move down, probably look at buying stocks with some of the good techniques. So let's just look at a few technical picks. Okay, so this is L&T. You can see how bad this chart looks like. It's been a vertical fall and a very weak rebound. So this is a case of a stock in the infrastructure segment. Most of the stocks look like this. Good company, but technically very, very weak. You can see how the plunges and the recovery is very anemic. The next one to look at is HDFC. Another stock with very weak technicals. Look at the rapid fall and very, very poor recovery here. So another weak stock. So these are the stocks to sell when the trend changes to down, which I think may happen any moment now. What about stocks with good technicals? So this is a good looking chart, right? So this stock is making higher highs and higher lows. So when the market bottoms out and when you think a bounce is coming, this is the kind of stock to look at because it's making highs. Another good stock to look at on a technical, purely technical basis, ITC. Yeah, initially it crashed quite a bit, but off late has been behaving okay. So in this zone, supporters seem to come in and finally we are about 200. It's not as good as Airtel, but still okay. And the PE ratio is very low on this. Then the big boy of them all, Reliance. Yeah, that fell initially, but it's recovering. So the thing to do is when the market falls pretty bad, you want to look at stocks like this in case there is a bounce coming. So I would right now look at selling short stocks with weak technicals and not buying anything because I think the market could correct downwards because it is at very, very critical resistance. Okay. And the PSU banks, which I didn't show you, are terrible. I mean, if you look at the graphs, there's a vertical fall in all of them. Probably at some point, some long-term value will emerge in them, but on a technical basis, they are not looking good. So this is Nifty. Okay. Now, finally coming to the sentiment part of it, and having a look at sentiment, everything seems to be in a little bit of euphoria right now. So if you look at the CNN Money's fear and greed indicator, typically when there is extreme fear, you want to buy, and when there is greed, you want to sell. So if you look in 2000, when we were in February earlier on, we were in extreme fear mode. So, and as the market bounced, now we are in greed. So that famous Warren Buffett saying comes to mind: "Be fearful when everybody is greedy, and be greedy when everybody is fearful." So now looks like a lot of market participants are greedy. So you have to be a little bit cautious here and be a little fearful. So sentiment-wise, we are in over-bullish, euphoric mode, which typically coincides with market corrections and not rallies. So fundamental technicals and sentiment point out that probably there's not much scope for too much of a high move from here in the market, and rather probably some profit booking will happen in the next few weeks. Maybe there can emerge a rally after that, but selling on strength is the strategy. The Nifty violated long-term support, and my guess is it is going to trend lower throughout the year. And given that we may enter a 5-year bear market, we could see a lot lower prices ahead. Okay, so the other interesting question now comes as, so the central bank response to all this, the crashes, what did the central banks end up doing? So the central banks started cutting interest rates, and most of the central banks around the globe have cut interest rates to near zero. So, and I'll show you that. So if you look at the interest rate picture globally, the US Federal Reserve almost at zero, European Central Bank is at zero, right? Bank of England close to zero. Swiss National Bank is at negative interest rates. So Reserve Bank of India is about 4%, but and going lower. So the trend in interest rates is zero. So now the question begs, so if another crisis happens here, do central banks have any power in them really to cut any interest rates further? They're already close to zero. So policy response is going to be challenging from here on. Okay, so you could make the argument the central bank recently started purchasing assets, particularly bonds, MBS securities, mortgage-backed securities. The central bank even said that they will buy junk bonds, and as of today, the central bank, U.S. central bank's balance sheet is about $7.2 trillion, and that is huge. So the central banks have a lot of power at their presence, but can they really save the day is open to question. My fear is that all the central banks have thrown at the markets have only pushed asset prices up without really restoring economic fundamentals. So there is an indicator, I'm not showing it to you, but there's an indicator called the velocity of money, right? So this is an indicator which basically tells you how money changes hand to hand in the economy, right? So the velocity of money today is basically below Great Depression levels. In 1930s, there was something called a Great Depression that happened. During that time, several industries disappeared. There were probably about 5,000 car companies before the Great Depression, and there were less than 50 afterwards. So the Great Depression lasted for a period of about 10 years, right before the World War came. And in fact, the World War was what kickstarted economic activity again. So we are in a period very similar to that. And same thing, the central bank tried to save the day. They cut interest rates. They purchased a lot of assets. But after an initial relief rally, like what we have had, the financial markets started collapsing. Okay. One thing I want to show you is the rupee chart weekly. This is the matter of concern. So the rupee chart has been on a vertical rise. In fact, if you go all the way back 10 years, you will see it has risen. The dollar has risen against the rupee from something like 45 to the rupee to nearly 76 now. So the question is, if so much money came into India, why is the rupee weakening? So there was always a disconnect between the stock market and the economy, right? So when that happens, usually something resolves one way or another. So either the rupee will have to recover or the stock market will have to come down. So the stock market went non-stop up, but the rupee went non-stop down, and that cannot sustain. So now what is happening is the stock market is catching up to the downside. So I don't see how the rupee can recover terribly fast given the macroeconomic backdrop. I think GDP may go negative at some point of time in the cycle. We've had an unprecedented lockdown where economic activity has virtually come to a standstill. So it's going to be a very big challenge. So unless the rupee starts recovering in a meaningful way, any stock market bounces in this year may not sustain long term. Okay, so that is something that we have to look at. The other thing I want to highlight to you is the Volatility Index in India. So this is also a sentiment indicator, you can tell. But from the recent crash, the Volatility Index has kind of fallen. It reached as high as 80. So the Volatility Index is basically a fear gauge. I'm looking to see how many people are actually betting that the market would go down. So simply put it, versus going up. So initially during the COVID peak, this index, as you can see, went all the way to 80. Now it has come down to 28 or 29. And actually, people have become a bit more complacent of late. So people don't think maybe the market may continue to fall. And this can act sometimes like a contrary indicator. And actually, the market may kind of fall again. Okay, so I ran through these things pretty fast. The reason I did that is probably to open more discussion on analysis of any asset class you guys may want me to look at. So I've looked at a lot more asset classes than what was discussed in this presentation. So to throw it up for discussion and to ask about any fundamental sentiment or anything with reference to any other asset classes, um, I thought I would have an extended interactive forum. So anyway, so we are in a depression which will probably last at least 5 years, maybe more. During this time, you will see the dollar get extremely strong. You will see debt levels spike. One of the reasons why I think bank stocks are terribly underperforming everyone else is because of the fear of NPAs piling up. NPAs have already crossed, I think, the 8 trillion mark recently. They were only half a trillion 10 years ago, the banking system. So you're looking at 10 trillion, 11 trillion in NPAs once the moratorium on various loans, etc. ends. And it's going to be ugly. So that's why you're probably seeing that bank stocks are not recovering as well. So during this time, you could have risky asset classes like stocks, currencies, commodities, particularly those of emerging countries like India, etc., crash a lot. So stocks are risky assets. And during periods of risk like what we have entered right now, risky assets don't do well. It doesn't mean that you have to sell everything and stuff. All I say is the risk is out there in the system. You could be down for 5 years. The long-term investment strategy will always work if you put some money in every month, and that you can keep doing. I have no problem with that. But this is an extremely risky period. So if I say long term here, I'm talking 10 years. So don't think you can invest something and make 20% return like what you have done in the last 10, 15 years, which we are all used to. Stock market just went non-stop up. We are entering into a period of extreme risk where stocks could be down a lot for a extended period of time. So this is not to say stop all your investments. All I'm saying is if you want to make long-term investments, do monthly SIPs. Do not invest lump sum in the market right now. The risk is way too high. Okay, so spread your risk out and do monthly investment. That's fine. Okay. Risky assets like stocks, currencies, commodities will probably crash a lot. Wouldn't be a surprise. Industries could disappear. Right. So how do we play this? Look at investments that are actually going up in value. Actually, the dollar is one of the few things which will go up in value. So that is one thing. US government bonds may go up in value, but they've already gone up so much in value and they are returning close to 0.5% in interest. So I don't know where the value is, but they may still go up. Another investment which has been attractive of late is gold. Just look at this. So this is a chart of gold in dollars. And that, if you look, is a non-stop up move, at least in the last 5 years or so. So we bottomed around about $1,100 an ounce, and now we are 1750. So that's looking as probably something to look at as a hedge. So gold is a good diversification play. It doesn't mean it won't go down. It could also go down if the dollar strengthens, but it is one of the few asset classes I believe which will recover also very fast. So if you look recently, it did fall on a weekly basis. If you look at gold, it did fall earlier on, but quickly enough, it kind of recovered. So gold in dollars, definitely gold and dollars, and probably in rupees. The rupee is a weak currency, so gold and rupees would be fine as well. Can offer probably some kind of hedge value here. So the gold ETF plays would probably make good sense. So, but anyway, we are in a rough economic period. Stocks will not do probably well over the next 5 years. Over the long run, if you invest systematically, you would make good returns. But this is definitely not the time to take risk because things can go down south any moment, right? So that's my view. My view is it will take quite a bit of doing to come out of this depression. The initial effects of the depression are just being felt. It could last a lot. So you have to watch out. Okay. Now I will throw open the session for questions or discussion, an extended discussion session, since I've gone through some key asset classes. And let me know your thoughts and what type of questions I need to answer. Go ahead.
Hello, sir. Good afternoon.
Yeah.
It was a great session. The only question I have at the point where you said rupees in comparison to dollar, may I know what factor do they take in point when they say the rupees is either increasing in the value or decreasing when compared to the dollar, sir, for the exchange rates?
Okay, so basically, the rupee, it took 45 rupees. It took 45 rupees for $1 was equal to 45 rupees back then. Since then, the rupee value has depreciated and now $1 by 75 rupees, right? So how has that happened? So the question you have to ask is how has that happened when Indian inflation rates have actually come down?
Yes, sir.
So the reason is money probably has gone out of India, right? But you still have had substantial money come into the stock market, right? So outflows, capital outflows probably have caused rupee to depreciate significantly. And long term, we need some stability in the rupee for the economy to thrive and develop, right? A strong rupee usually will keep inflation down and keep interest rates down, which usually is required to sustain economic growth. So hence, yeah. So the question is, yes, so rupee is worth a lot less because the dollar's purchasing power has considerably increased because money is moved out of India.
Okay. Thank you, sir. Thank you so much.
Question?
Good afternoon, sir.
Yeah.
Sir, as you said, like a few days back, we could see Nifty breaking the level of 10,000.
Yeah.
So is this a sign of recovery in this condition or is just a temporary spike so that we have a shorting position there?
Yeah, so the 10,000, I would look at 10,150 as the critical level because that is a 20-day weekly moving average. So 10,000 breaking that was a positive. So my guess is the weekly close will also be a positive. So short term, we may get 100, 150 point move, but that usually this type of technical setup when the market goes vertically up, if you realize Nifty has been up 1,201.5.
Yeah.
This is clearly not sustainable, particularly at a resistance. It may recover somewhat, maybe get to 10,500, possible. But after that, possible move down to 9,500 and lower is very much on the cards. Because both the valuations and the technicals are stubbornly against the market right now.
Yeah. Okay, sir. Thank you.
Sure. Next question. Yeah,
Good
go ahead.
afternoon.
Go
Hello.
ahead.
Yeah. Just a small query. The US markets have shown a sharp recovery. In fact, they have reached the pre-COVID levels. So, what do you attribute this recovery to? Because the US has been affected the most.
Yeah. Yeah.
So,
So the
isn't it
US,
surprising?
yeah, good question. So the US market is the leading market. So after post right now it has recovered. Probably it is within 10% of all-time high. If you look at the S&P 500, right?
Exactly.
So I'll just bring it up on the chart if you want. Yeah.
Thanks.
So that market recovery is mainly due to Fed action, right? Fed has bought $7 trillion worth of assets, kept interest rates low. They've cut interest rates to 0%, near 0% now.
Exactly.
So just as a reflex to that, the market has gone up. But please remember, the same type of sentiment and environment was prevalent in February when the market was trading at all-time highs. Nobody thought the market would come down like this. And the same environment is prevalent now. Now, the question is, interest rates are zero, right? So why don't people take the money out and spend and sustain the economy? They tried this experiment in Japan, right? So in Japan, in 1989, there was a huge stock market crash, economy crash, etc. And the central bankers there cut interest rates to negative, right? Like what the US is now going.
Yes, sir.
What happened is in the 30 years since then, the stock market crashed almost 50%. It's not recovered. So what happened in Japan is happening. It has happened in China. So my guess is America is next.
So you don't see the levels sustaining?
No, I don't see it sustaining for one bit. And I think we'll be down for 5 years. I mean, any recoveries tend to be artificial.
Okay. Okay, sir. Thank you so much.
Yeah, thank you.
Hello, sir.
Hello?
Hi.
Yeah, hi, good afternoon, sir. This is Gurpreet, your ex-student.
Yeah, hi.
Hi, sir. So your session was good one, but I want to ask a question. Like around March, Nifty broke around 8,000 minus, but today it's covered almost 2,000 points. So what do you think is the reason for recovery for being like 10,000 plus today? So do you think it's reliable?
See, as I told you, the overvaluation in the Indian market is still continuing after the recovery. So P ratio nearly 24 now. So the P ratio was 28 prior to this crash in February. So we are in overvalued territory. So we were extremely pessimistic at 7,500 on the Nifty back in March. So people were too pessimistic. So this is more a reflex rally, right? Relief rally. So it was expected, even in the Great Depression and in 2008, the market first crashed 60% and then recovered 35% of the lows and then crashed again, right? So we are just doing the normal recovery thing and the fundamentals are not very good right now. So, and the techniques are at resistance. So I wouldn't be making major long bets here. So, right. So this thing can reverse and hit resistance and turn down any moment now. So 10,150 is my level to really look at because the 20-day moving average, which is a weekly moving average, is crossed below the 200-day weekly moving average. When that happens, crashes continue. So my view is the downtrend may resume any moment now.
So I want to ask that, like, which sector could we prefer in the long run in the stock market today? Because I think pharma, agriculture, FMCG, I am not worried about them, but I'm worried about banking. So do you think it will be stable enough in the long run?
So banks will probably offer, I think if you have something like an SBI, for example, I mean, SBI is a huge bank with a big asset base. So, and it is trading very, very cheap now. But the problem is you should be long term and you should buy now. And when it goes 20% lower, you should be ready to buy again. So that's a long term bet, right? But short term, things could get more ugly before they get better. So if you're purely looking for short term money, I wouldn't be in any value stocks. I would be in the stocks that actually are showing good technicals like Bharati Airtel, for example, to an extent ITC, Reliance, for example. But I wouldn't be buying them at these levels. I think the best rally possible has already come out of those stocks. So when the market corrects again and you feel like buying something, buy the stocks with the good technicals.
Surely, okay. Thank you, sir.
Thank you.
Hello, sir.
Hi.
Sir, this is Tejashwini, your student, 1820 batch.
Hi.
Sir, what about crude oil, sir?
Okay, so that's an interesting chart. I'll bring it up again. Crude oil in dollars, I'll just bring up.
Yes, sir.
Okay, so that chart again, if you probably have been observing what has happened with crude oil futures at one point traded negative. Okay, can anything trade negative? Well, crude oil did at one point of time. There was extreme panic. There was a lot of supply, and then OPEC came in and tried to save the situation. But it has had a nice bounce of the low, and almost is now quoting at close to $40 a barrel. So I don't think that sustains. I think the technicals, if you look, it's crashed in 2008 before the recession. It was at $120 an ounce. So it crashed to $10. Again, it crashed to $10 this time round. Nice rebound to 40. My guess is these type of economic conditions probably justify $20 or $15 crude rather than $40 crude. So my guess is after some time, crude will come down again.
Okay, sir. Sir, if you want to do any weekly investments, now which industry is the best?
So you have to look at the technicals. As I said, right now, most of the stocks seem to be at resistance. So I don't know. I never recommend anything for short term because I have no clue what happens in the market today, tomorrow, or whatever. But the medium term trend, I believe, the downtrend is what will resume. And the risks to the downside are more than the upside. But like I said, if I want to buy something, I would buy the ones with good technicals that are holding up better than the rest of the market. Stay away from the bank, stay away from infrastructure, stay away from even the auto segment. So stocks like Maruti, which have rallied quite a bit from the lows, but economic activity is going to contract quite a bit. So long term, stay with the stocks that are probably bullish, both fundamentally and technically. Something like an ITC makes sense long term.
Okay, sir. Thank you, sir.
Hi, sir.
Yeah.
This is Srinivas here.
Yeah, hi.
Thanks for your insightful presentation.
Hi.
You said something about diversification into gold.
Yeah.
Should we say, if we are doing a systematic investment into gold, should you go ahead and purchase the gold coins like 5-gram coins or something? Or should you invest in government sovereign gold bonds?
Yeah,
Which one do you suggest?
Good point here. Yeah, I think sovereign gold bonds definitely make sense because they have an interest component to it, right? So your downside is a bit more cushioned than if you buy gold. Gold in itself, in the short term, it may come down a bit, but I think in the next 5 years, gold will do better than stocks. There is no doubt in my mind that gold will do better than stocks because it is a hard asset versus the paper asset that is stocks. And given what is happening in the global economy, people tend to buy hard assets rather than paper assets. So it's a good diversification. Would I put all my money in gold? No, but probably about 10% of my portfolio in gold over an SIP type gold ETF or gold sovereign bonds would make sense. Yeah.
Hi, sir.
Hi.
I'm Jamuna here.
Hi. Hello, ma'am.
Sir, how are you?
Good.
It was a
Good.
good sir.
Tell me.
Sir, should one continue with SIPs and concentrate on large or small caps? So,
I would not be touching small caps at this point of time because when the economic cycle is going down like this and lasts for 5 years, some of the small caps may actually go out of business. So I would only stay with liquid large caps. So large caps tend to hold better in economically down periods like this. So large cap funds and gold funds probably would make better sense on an SIP basis, no lump sum investment.
right. All right. Thank you.
Sure. Questions?
Hello, sir.
Hi.
I wanted to ask a question regarding the energy sector.
Yeah, go ahead.
What about energy sector coming forward predictions and for energy sectors?
So energy sector means any particular stocks in that?
ONGC.
Okay. So again, see, this is an economically weak period. Crude oil prices are going to probably crash again. So
Okay.
that's not going to be good for the energy sector. But some long-term value is emerging in stocks like ONGC. That is definitely the thing. And ONGC has come down quite a bit, but is holding up okay. So my guess is long term, I think there will be better buying opportunities later on.
Okay.
At some point of time. I think it has bounced nicely recently. So, but Reliance, for example, is holding up not better because it's got that geo component. It is not a purely energy, and that side of the deal has cushioned it a bit. But energy, I think long term, usually the energy stocks tend to pay a good bit of dividends.
Okay.
So long term, I think probably you could look at probably getting into them year end.
Okay. Sir, talking about Reliance, they have got lots of investment in the coming months, last months. So how in this situation, how did they make these investments? Like the investors were not fear about investing in these companies in this situation.
Okay, Reliance has held up okay. I mean, it bounced very back strongly from the lows and even made new highs. But my view is that that was purely a technical bounce. Yes, a lot of good news is there, but it has not been able to go significantly above 1650 level. So my guess is the entire market seems to be at resistance now. So that Reliance may hold better than the rest of the market, but I think if the market comes down, it will also come down.
Okay, but what made the investors invest in this right situation?
Okay, see, the investment is a long-term investment betting on the Indian consumer market, right? So Geo probably will have a lot of huge consumer base, say 5 to 10 years from now, and that's what companies like Facebook are betting that they want a part of that. So today, if you look, Amazon, Bharti Airtel is being talked about. Is also in the news. So Indian market long-term dynamics, the consumption dynamics, you probably don't have to question because the population is trending up, right? So, but in the next 5 years, the consumer won't be easy to please and win over because I think the disposable income of the consumer is going to come down quite a bit because of joblessness and COVID-related dislocation in the economy. So that is the case. All these consumer plays will come down.
Okay. So, last question.
Yeah.
So, there was rumors going on regarding the interest waiver during the moratorium period.
Yeah.
So, is that true? And what will be the impact in the stock market?
So, moratorium, I don't think can see. Already the banks are bleeding. So, their income measures are all suffering. NPAs are going to pile up. So, if they give an interest waiver, then they will have to write quite a bit of stuff off, which is not going to be good for the bank. So everybody is worried about the banking sector, rightfully so. Banks have fallen quite a bit, and the banking segment. So if there is a rumor and something happens, initially you may get a 5% move in Bank Nifty, and then big correction after that.
Yeah.
So banking rallies in the banking sector are unlikely to sustain.
Okay, sir. Okay, thank you, sir.
Sure.
Thank you.
Sir, I have two questions.
Yes, sir.
So, one is, I'm surprised how come Bharti Airtel is doing well because they are in very bad shape. That is my first question. Second question is, since you said that look long term, is it time to go a little slow on mutual funds, SIPs?
Okay, so the first question is Bharati Airtel is still the leader in that segment, and despite Reliance Jio, people have come to the conclusion that Bharati Airtel is going to be around long term and probably compete on level footing with Jio, and so hence it's been given a market premium as the leader. So it has been able to sustain very well and do very well, and the technicals suggest maybe that is one of the few stocks that is holding up But it doesn't mean to say that it may not fall. So eventually the good stocks also do fall if the weakness returns, but the good stocks tend to bounce back faster. So hence the technicals look like that as though Bharati Airtel is one of those strong stocks that every time it goes down, people are willing to buy and push it up. So one of the stocks with good fundamentals. The second technicals. The other question regarding to mutual funds is, yeah, I wouldn't be aggressive on mutual funds right now. Mutual funds are long-term investments. If you have SIPs, keep them going. No issues with that. But increasing the SIPs, you want to do a huge up in your SIP investment, I would probably wait till year end and then start phasing in gradually. For example, the NPS is a good avenue to invest because they have an SIP type system built in.
Okay.
That's your long-term investment and you don't worry about it. But lump sum in the market right now is too risky.
Oh, thank you, sir. Thank you so much.
Yes.
So Mahesh here again.
Yeah, hi.
Hi. So looking at our affinity for gold and our gold reserves, do you think India handling the next few years in a much better way than even some Western economies? Do you think gold reserve will be to our advantage?
Okay, so India has good reserves, no doubt in mind, but India also has a weakening economy and we are subject to capital outflows. So the rupee is a very big concern, right? So capital outflows can destabilize us much faster than we can even imagine. So that is the worry that I have, that at the slightest outflow of capital, when economies go down again and risk appetite wanes, we may see a lot of exodus out of India. So India has good, like I said, reserves, like I said, but we are running a current account deficit and we are subject to capital outflows. So these two things are problems in the near term, at least the next 2-3 years. Yes. Question?
Hello, sir.
Yeah, hi.
This is Medha. Good afternoon, sir. So my question is regarding the real estate. So according to accounts, there is a theory that says land never depreciates.
Yeah.
And given the situation now, and also the Commerce Minister Piyush Goyal had earlier said that cut prices and sell instead of waiting for the market to recover.
Yes.
So what are your views on this?
No, I think real estate is going to be down quite a bit. I think for 10 years. I think this economic cycle is a big one. Land will be down a lot lesser than, for example, flats.
Okay.
In flats, I think there is still too much supply. So I think the impact will be a lot more when joblessness actually starts to rise in the IT sector.
Exactly.
Land value will definitely depreciate, but unless there are huge sellers, it may not depreciate as much as what is happening in the flat segment.
Okay.
So, but I think it is going to face downside pressure. There is no doubt in my mind because economic activity is going to decelerate sharply.
Okay. Yeah. Thank you, sir.
Sure. Any other questions? So I think somebody had posted about investments in gold. So gold is usually a diversification tool. So you can invest in sovereign gold bonds through a demat account, or you can invest in a gold ETF. Sovereign gold bonds, pretty much, they give you an interest component too. So, but I wouldn't put all my money in gold bonds. So it's basically a hedge to your portfolio. So some of it in gold, say 5 to 10%. Okay, so there's another question which says, so what is the future state of mergers and acquisitions in Indian market? So typically in down economic activity, mergers and acquisitions will come down. So typically only when there is a economic recovery will mergers and acquisitions pick up, because companies first won't have money to buy another company, and number two, valuations at peak levels are usually a little higher. So people will wait and see before they buy. So which sectors NRIs should consider as good for investing in India? I would probably look at stock specific. Long term, I mean, something like ITC, which is good fundamentals and technicals, probably would make sense. But like I said, I wouldn't do any lump sum investment. Monthly investments are okay. Okay, so another question. First one is, will mutual funds work during this situation? Mutual funds will work long term, and here I would be very careful in saying long term is 10 years or higher, because we could be down for 5 to 6 years very easily. At that time, you accumulate, and if you're a long-term 10-year holder. But today, no, everybody says long-term is 6 months. So if that is your view, then very risky to invest right now. So long-term is 10 years. So in that time frame, mutual funds will work. Yes. So are we going to see any fundamental changes in policies to attract? The government has tried all it can. I mean, I don't know what more they can do, really. I mean, maybe cut the capital gains tax, maybe try a few things here and there. But this government is definitely investor friendly, I would think. But in this type of environment, no matter what you do, capital, people have to have money to invest, right? So people try to protect money in this type of market environment. And okay. Any other questions? So the time duration for investing in SIPs was a question. So I would have at least 10 years in mind if you start an SIP now. Okay, investing in Gilt funds. So that's a good one. So Gilt funds have given good returns because 1 year and 6-month interest rates have come down a bit, quite a bit, as RBI has cut interest rates. That trend is likely to continue. RBI is going to keep on cutting rates because I think the economy is going to weaken quite a bit. So gilts are good diversification tools, though the return on them is not going to be huge, but it will definitely do better than stocks in the next 5 years or so. Covered that. So which industries thrive in depressions? Usually FMCG and pharma. But even those, I mean, the industries themselves do well, but the stocks can go down if the situation, I mean, in this case, in the short term, maybe FMCG and pharma do well. But I wouldn't buy stuff en masse here because everything can go down. So long term, those sectors will probably do better. And in pharma and FMCG, you should be very selective and buy stocks low PEs if you can find them. ITC is one that I see, but there could be a few more. Okay, so a question on insight into the automobiles growth. Automobile demand is going to come down. It's already coming down. There was basically zero demand when COVID happened. Slight recovery has happened now, but people have to have surplus cash to buy high-priced items, right? So automobile demand is definitely going to come down. Those stocks will probably underperform the broader market. So some companies are available at 50% discount to the 52-week high. In a bear market, you can even get 80% discount. So that doesn't mean they're cheap. So if you're playing the recovery rally, probably stay with stocks with good technicals, not the ones that are down a lot of. PSU banks, some of them are down 80%, right? So it doesn't mean they're going to recover tomorrow. It may take some time. So again, this is PSU banks as an investment, long term, 10 years, 11, 12, 15 years down the line would make sense. You keep accumulating maybe one or two, maybe SBI, but short term, no. Growth of aviation stocks, aviation is going to suffer. You know, aviation, high-end aviation, business travel is definitely going to suffer. So those stocks will come down in value, I think, over the next few years. So MSMEs are going to have a tough way forward because of what has happened in China and all that. So many of the MSMEs were dependent on China for their raw material. Now raw material just doesn't come from China as it was before. So MSMEs are going to suffer. There are challenges. The good ones will survive and do well, but there could be a lot of going out of business in that segment. Okay, companies are raising money from the market. Is it going to help in market recovery? Well, companies are raising money to survive. If they issue a lot of stock, usually stock prices are under pressure. So right now, the good companies are raising money to survive the next downturn. That's how I see it. It's not likely to boost sentiment too much. So can MSMEs get their raw material through other sources? Eventually, that's what they have to do, or do something in-house, but it cannot be done overnight. So when customers suddenly don't get their orders, they will just cancel and move to someone else. So supply chain and disruption is very, very real. So the companies that adapt and quickly fix these supply and distribution channels are the ones that survive. So why is companies investing in telecom sector? It's because of the user base. Telecom companies have huge user base, so all the big companies in the US want a portion of that user base. So hence they are investing. Okay, alternatives like angel investing and cryptocurrencies, will they gain attention during this market downturn? I doubt it. They are even more risky. So my guess is all those venture capital investing, angel investing, cryptocurrency investing, everything will come down because they are more risky than even stocks. So my guess is all that will come down. View on pesticides and agrochemical. So my view is that if economic activities declines, then all these segments will be impacted, right? So my view is that these companies will be impacted too. Demand for their products will be impacted too. So what percentage of my income should I invest in stocks and mutual funds in an ideal case? So there is a life cycle investing concept where you put your age in bonds or fixed income and 100 minus your age in risky assets like stocks, right? So if you are 25 years old, you put 25% of your investments in fixed income and keep some of it in cash, and the remaining 75% in stocks. As you get older and older, you reduce the equity exposure and kind of move it into fixed income. So this is the way you do it. So ultimately, when you're old, you have most of your money in fixed income. So if the market crashes, you don't lose anything. So that's how you do it. So India gaining business shift from China. That is a difficult thing to say. Some industries may shift, but still the labor base and the productivity equation is a little bit to China's advantage as of now. So companies are not immediately reluctant, but some of it may. MSMEs have to be sustained, but it is going to be a challenge. So a lot of stimulus, I'm sure, will come to the MSME segment, but I have no idea of how they are going to work things out. I mean, the good ones will survive and do well, but there'll be a lot of failure in that segment. Okay, so banks with low capital adequacy and high NPS, will they collapse? RBI hasn't let anybody collapse. They bailed S Bank out recently, asked investors to bail S Bank out rather, but it'll get ugly. I think a lot of banks are very weak now. Their CARs and are in huge decline. So ultimately, it's going to be a problem. Eventually, the economic weakness will translate into huge amount of NPAs, and there will be a lot of banks under pressure. Pandemic-based downturn will ultimately result in economic downturn. So they are not really different because ultimately economic downturn happens no matter what the cause is. So very related. So delisting happens after prior notice. It takes usually, I think the SEBI has given some guidelines on it. I'll have to check the exact time frame. But the companies will intimate their shareholders and ask them to tender their shares. So that's how the delisting process comes up. Shares like Ashok Leyland, see, Ashok Leyland is integral part of the economy. So if the economy is weak, they'll suffer. Ultimately, maybe over a 10-year time frame, they may survive and do well. But this dislocation is very real, and we don't know how bad it can get. And my view is that over the next 5 to 10 years, you'll see that this COVID disruption is a lot worse than most people anticipate. Okay, I think I've cleared all the questions. Oh, there's more. Okay. So is it better to invest in mutual fund? Yeah, like I said, SIPs only, no long term. Okay, why are shares pledged? So companies pledge shares because if they've taken out loans as collateral, they will pledge shares sometimes to the banks. So what happens is when share values decline, the banks will require more collateral, and as a result, they will sell the shares when they're going down, and that will create more problems. So sometimes companies do pledge shares as collateral, and that actually compounds the problem. Any other questions? Further questions, you can privately contact me. I share my number. You can WhatsApp me or anything. So thank you. Will banks run out of cash? Yes, that's probably going to happen. Yes, so we have to worry about it. Banks do run out of cash at these times. So the good ones are trying to raise money now and hope the RBI doesn't need to bail them out, but it's going to be a problem. So, okay, I'll conclude the session with that. Thank you so much for joining in and tuning in. If there's any further questions, please do let me know. I'll be more than happy to discuss anything offline. Thank you.